Hello and welcome to another webinar brought to you by Truck Writers, featuring expert speakers Nate Nelson and Brett Larson, joining us from Messerly & Kramer. Today they'll be discussing the suitability and efficacy of trusts for businesses of varying types. A little bit about the technology before we begin the webinar today. Your lines have been muted for the duration of the web seminar. You can enter questions into the question box to the right and slide the window closed, but do not click the black X or you'll exit the web seminar. And without that, we'll begin with Nate Nelson.
Thank you, Andrew, and thank you, Truck Writers, for hosting us today. I'm here with my partner, Brett Larson. We're both from the law firm of Messerly & Kramer. Our topic is trusts for business owners. As many of you may know, my practice is corporate. I'm a part of the business services team at Messerly Kramer, and I buy, sell, merge, destroy, and create companies. I also do estate planning for entrepreneurs. That means wills, trusts, and all the documents in between. My colleague and partner at the firm is Brett Larson, and he'll introduce himself.
Thank you, Nate. Brett Larson. I'm also a corporate attorney with Messerly & Kramer. I represent mostly closely held businesses and their owners. I serve as general counsel, overseeing corporate org, reorg, and overseeing litigation for clients in Minnesota and across the country. I also advise them in matters of succession and exit planning, which overlaps often with the estate planning of the individual owners.
Thank you, Brett. Today our topic, as I said, is trusts for business owners. And admittedly, the concept may appear a bit complicated. The techniques are sometimes, in some cases that we'll be talking about, highly regulated. I think if there's one gist to take away from this seminar, it would be what is the purpose of the trust and when does the trust apply? Well, like I said, admittedly, the trust may be a bit complex and the slides may even be deeper than we would otherwise intend. Brett and I both take pride in making the complex simple, and we have a motto that we wouldn't want you to sign something you don't understand. So if any of the techniques we're going to be describing today are of interest to you, please don't let the details of the presentation take away your implementation of the strategy, as we would be happy to discuss this specifically for you at a time down the road. An overview of what we're going to be talking about, we've clumped into 4 separate batches. One I'm going to call the Business Management Trust for the business owner that is not ready to make a major change in ownership during his or her lifetime. The second trust is kind of what I'm going to consider the star of the show if the business owner is seeking to transfer the business for consideration for money to the family members. It does not have to be to a family member, but that would be the key and most logical transferee of the business, and that's in the intentionally defective grantor trust. The IDIGIT is what we call them. Brett will be talking about trusts that can provide business owners with philanthropic. Help me out.
Philanthropic.
It's so hard for a lawyer to say that word. So with charitable interests, but also with income tax and estate tax benefits, as well as some business management purposes, whether it's on a back end of a sale or on the front end of a sale. That we call these charitable remainder unit trusts and charitable lead annuity trusts, or they're commonly called CRUTs and CLATs. So without further ado, I'd like to talk about the lifetime trust, which I really have seen appropriate for what I'm going to call the reluctant business owner transferee. The person is senior in years, may or may not have obvious candidates to succeed the business, does not want to sell the business, looking for a legacy so that the business would continue after his or her death. However, is either having too much fun with the business, does not believe the business could operate without his or her control, or just does not yet believe the beneficiaries are in position to run the business or operate the business in the unfortunate event something would happen to the entrepreneur. The first of this class of trust is going to be what I call the inter vivos revocable trust. It's also very similar to a simple estate plan revocable trust, where we would create a separate trust for the entrepreneur simply to hold the business, whether that's a holding company or all the operating entities that the owner already owns. So if the owner owns an operating company, a leasing company, and a real estate company, this trust, the business management trust, may be the owner of all of those assets. The purpose of the trust is, in the unfortunate event the owner becomes incapacitated without ever having made the decision how to transfer the control and the ownership of the business to somebody else, what happens to the business? Candidly, without such a mechanism, it may be a free-for-all, which, as many of you know that have gone through family fights, it's free as a misnomer there. But at a minimum, there'd be unpredictability, uncertainty, and at the worst case scenario, there could be a fire sale result of the business, or just a diminution of value because there's not a team in place. So what we do for this business owner is we basically keep the owner in control for so long as the owner likes. In the event the owner is gone, we say to whom upon the owner's death will be the beneficiaries. It could be the spouse, it could be the children, it could be grandchildren, it could be trust for certain of those persons. But in the event that the owner either decides to become an absentee owner, or if the owner becomes incapacitated, and imagine a situation of dementia where the owner could live 10, 15 more years yet without being able to control or actively manage the business, we put forth the succession of management through a trustee position. And the trustee then will be the shareholder, if you will, of the business and the ultimate decision maker. The advantage to this approach is, in the unfortunate event the owner is not able to act, he or she has already identified the next best choice to be the decision maker. From there, we've even gone so far as to set up who would be on the boards of, say, the real estate holding company or the operating company or the equipment leasing company, who would even be the managers and the officers of those companies. We can get down to that level of nitty-gritty, if you will, with the idea being that while the owner has been reluctant to decide who or when to part with control, at least management is in place. For the person that can't even bear to make that decision during their lifetime, and there's many of you out there, we can incorporate these same techniques through a testamentary trust, whether that's created under the owner's will, or if they're operating out of a revocable trust during their lifetime, we could create a trust inside that trust that would become operative upon the death of the owner. So it would basically incorporate the same structure that we spoke of in the prior trust, where a shareholder trustee would be appointed for the major decisions, a board would be appointed for the organic decisions, and officers may or may not be appointed for the day-to-day decisions. For the person that is saying, I've had enough right now, I'm ready to part with the business, I'm just not ready to give my beneficiaries control, we can also create irrevocable trusts for the owner, where it will be removed from their estate, which would have estate planning benefits potentially, but it would mirror the techniques of the testamentary trust for the owner, but only during their lifetime. So there's a whole bunch of ways that we can secure control of the business for an owner if they're not yet ready to part with equity. There are downsides, whether the company is an S Corp or not, and we would work with your accounting to help best structure solutions for S Corps, for S Corp businesses. There'd be no problem during the lifetime of the owner. There could just be some situations that come up when the owner is gone. Finally, for the owner that is willing to part with equity but does not want to part so much with control, we have, like I shared with you earlier, what I consider the star of the family transfer, and that is the sale to an intentionally defective grantor trust. This trust is sometimes I like to say it's almost too good to be true. What happens is that there's a transfer of the business to a trust where the owner's children or trusts for the children, if they're not responsible or in a position to receive the assets yet, would be the beneficiaries, all at no tax. So some of the impediments to making a sale of a business to a child are basically, one, am I going to get my value? Two, who's going to pay for it? My children are not in position to pay for the business. And three, my children just aren't ready to receive the interest as much as I'm ready to give it to them. What we can do here is we would create what's called the intentionally defective grantor trust, where the owner would gift, and don't get mad at that word, but the owner would gift 10% of the value of the transfer into the trust, and then the trust would buy the rest of the interest that the owner wants to transfer. So if the company had 100 shares and the owner wanted to transfer 80% of the business to his children, if you will, tax-free, there'd be an 8% gift and basically a 72, or I guess a 10% gift of 8 shares, and then a sale for 72 of the shares. The shares would be at fair market value. The buyer would be the trust. The trust would get the proceeds to pay the owner the fair value of the business out of the profits of the business. So the amazing thing there is, if we all know at the end of the day that children should be the buyer, but they're going to get any means to afford the business by the income they earn from the business without having to kick up the salaries to the children, we can have the trust be the buyer using the distributions that would otherwise go to shareholders, go to the trust, and then the trust takes those distributions and pays off a promissory note to the owner for those shares. So from that perspective, what we've done is we've gotten the business out of the parents' estate, we've gotten the parents an income stream or the owners, an income stream that they can predict upon and that they want to do, and we've kept the business within the family. If the children would ultimately, or a child would ultimately be the beneficiary of this trust. If the child is a risk of mismanagement or could lose the shares in a divorce or have other issues, we could have a trust for the child be the ultimate owner of these shares. Finally, another candidate for this type of a sale would be where the owner has several children but only one has an interest in the business. How do you treat all the children fairly? There could be a sale to one child, a sale to a trust where only one child is the beneficiary. All of the proceeds of that sale will be paid by the trust to the owner, and then the owner could take those sale proceeds and distribute that value to the other children. In that fashion, no one child got an advantage over the others. The owner was able to get income and maybe or maybe not keep control. That's up to the owner. And at the end of the day, the child is certain that he or she will be the ultimate recipient of those shares, which will keep the child interested in working in the business at least through the lifetime of the owner, if that is the intended result. So that is, I guess, the high points of these trusts that I'm talking about for the owner who wants to retain control and maybe transfer during their lifetime or upon their death, and targeting within the family. Brett now will talk about trusts where charities have an interest in the transaction.
Thank you, Nate. So don't be thrown off by the word charitable in either of these trusts. We model them out to net you as the business owner and seller of your business more than you would net on your own personal balance sheet if you do not do the trust. So put another way, you don't need to be terribly charitably inclined to follow one of these strategies. You just need to really be somebody who would prefer to keep more money for you or your family rather than pay that amount in taxes. So the CRT, or the Charitable Remainder Trust, or we'll refer to them called it CRUTS, Charitable Remainder Unit Trust, that strategy really works best when one of the goals of the business seller is to gain access, maybe in retirement or for any other reason after the sale, to the proceeds of the sale immediately. Diversify those holdings rather than holding a large percentage of your net worth in your closely held company. Now you can diversify those holdings in a variety of different investments, and to significantly decrease your tax burden. We'll talk about how that works and how a CRT can be used to accomplish all of those goals. The second set of goals, I guess, specific to the seller of a business are better served by the CLT, or Charitable Lead Trust. And that trust really works best when the business seller still wants to avoid or minimize capital gains taxes, but has decided that all or a portion of the proceeds of the sale of the business will really be set aside for the family and really aren't needed by the seller of the business, at least in the short term, and by short or midterm, and by that I mean typically 10 years in order to maximize the benefit. So we'll talk about both of these strategies, how they work in the sale of a business, and you'll see why you might employ one of these strategies, depending on your goals. So first, a charitable remainder trust. What are they? The IRS refers to them as split interest revocable trusts. Split interest meaning there's a non-charitable interest, meaning that the interest that goes to you as the grantor or to your family for a term of years. And then there's a charitable interest, the remainder of the trust after the term of years, whether it's your lifetime or 20 years, the remainder will go to a qualified 501c3 charity. And I'll show you an illustration of how that practically will work over the life of the trust. Why would you use one of these trusts to sell your company? So practically, the way this is going to work, you're selling your company for, let's just use round numbers. So you're selling your company for $3 million. You decide $1 million of that $3 million I want to minimize taxes on by using this CRUT strategy. So we take 1/3 of your stock, we transfer it to the trust. The trust actually sells that stock or assets, if it's an asset sale, along with the other $2 million. Okay, so the trust is the seller of that stock. It receives $1 million for the sale of that stock. There's no taxes. There are no taxes due on the sale of those proceeds. So the trust ends up with $1 million net of taxes. It pays no taxes on that, and that $1 million can be used to fund any range of investments. So you're able to diversify your holdings now without paying any tax on that diversification event. The owner who contributes $1 million worth of property to the trust, they'll get an income tax deduction in year one. It's typically about 10%. So if you contribute $1 million worth of stock to the trust, you get a $100,000 deduction, which you can use against your other income that year. The third benefit, and we'll go through specifically how this works, is tax-deferred growth. So that $1 million that is sitting in the trust is invested in assets that are designed to produce long-term capital gains income, and that income is not taxed within the trust. And then fourth and finally, the most significant benefit of this strategy is to really model the trust and model the payments that are coming back to you as the grantor to reduce the effective capital gains rate that you pay on the money that you receive back from the trust. So you're not paying any taxes on the sale proceeds. You're receiving an income tax deduction in year one. You're not paying any taxes on the growth within the trust, and the money that you do receive back, you're paying a 15% capital gains rate versus the 23.8% that you're paying, and that's just federal. That's taking out of the equation any state capital gains or income taxes that you avoid or minimize, and it's also taking out of play the benefit of one thing that we all expect, which is a reduction of capital gains rates as we go forward. So when to consider using a charitable remainder unit trust? If you're selling a business, if you're trying to diversify stock, or if you're selling highly appreciated real estate. So basically, any asset that is low basis, highly appreciated, that you're going to pay a significant amount of capital gains tax on in the year of the sale, that is an event that should lead to consideration of this strategy to spread that income over a period of time during which you will control the income and you'll control the asset, but by spreading the income you're going to minimize the taxes. And this strategy also allows you to diversify your holdings, as we've touched on a moment ago. So it's easiest, I think, to understand the strategy if we use an example. So take our example that we were talking about earlier. We contribute $1 million to the trust. Let's assume a very conservative growth rate of 5% per year. So on average, that $1 million is sitting in the crud. The crud has invested that $1 million in a range of investment products, mutual funds, bonds, stocks, and let's just assume on average the growth rate of that is going to be 5%, which is below the industry average for the last 30 years. But to be conservative, let's use that number. And this particular trust will model it in order to make sure that we maximize the tax benefit to you as the grantor. But let's say, just for the sake of argument, on this trust is going to pay out 11% over the next 20 years to you. So the trust starts with $1 million, 11% of that corpus that's in the trust, which will again continue to grow at a rate of 5%, but you're taking 11% of that corpus out every year over 20 years. It'll be, as you'll see in a moment, that the amount of money will reduce because we're taking as a percentage of the trust more out than the trust is creating in terms of growth. In this scenario, the present value of the remainder interest is just over $100,000. So that is the amount of your charitable deduction that you're going to enjoy in year one against any other income that you have. So for a moment, we'll take a break from that example, but we'll go back to it. But I want to outline sort of where the breakpoints are in income that really incentivize us to employ strategies like the crud or the CLAT. For any year for a married person in which you make over $250,000 in adjusted gross income, you're going to pay the 3.8% net investment surtax or the Affordable Care Act surtax. In any year that you're over $470,000 married, you're going to pay a 20% federal long-term capital gains rate as opposed to the 15%. That 20% and 3.8% stack to get you to a 23.8% tax. So if typically your income is below 470 or even can be modeled to be below 250 long-term capital gains income going forward and after the transaction, you can see where if we have one big income producing event in 1 year, like the event in the event of a sale of a business, we're going to pay that 24%. Plus in Minnesota, for instance, almost 10%. So we're going to pay almost 34% in taxes in that year, when by spreading that income over a longer period of time and avoiding that one significant event in the year of the sale that pushes us over these thresholds, we bring our effective rate from that 33.65 down to closer to 18% total. So the flow of funds, this illustration kind of helps to understand how practically the trust is going to work. You establish a trust and make a gift, that's step one. You form the charitable remainder trust, you put your stock or your real estate or your highly appreciated low basis asset into the trust. Then the charitable trust sells that asset, takes the money, and you receive a fixed or variable income over the life of the trust, and at the end of the trust term, the balance will go to a charity of your choice. This model helps to show given our example, given our $1 million contribution, our 5% growth, our 11% annual distribution, this shows the amount of money that we'll start with. If you look at the growth number in the third column, that number is investment growth of the asset within the trust. You're not paying any taxes on that. The distribution, the next column, is the column that most of us are most interested in. That is the amount of money that you're going to receive in a wire or cash payment out of the trust. Some people will set that up and use that as a subsidy to their income in retirement. Some people will have that money just set aside in a different brokerage account, but that is the amount of money that will come back to you over the life of the trust. You go all the way to the bottom of that column. 1.5 is the amount of money that you will receive in payments out of the trust over that period of time. And we model this out to make sure that your income from the trust, in addition to your other income that you have outside of the trust, will be below those thresholds that we talked about earlier, so that we pay an effective rate of somewhere around 15% federal instead of 23.8%. And this next slide is the slide that helps people really make the decision whether to do this or not. So we'll take your particular circumstances, including those related to the transaction and outside of the transaction, and model out for you over the life of the trust. What does my personal balance sheet look like if I don't do this, and what does my personal balance sheet look like based on this transaction alone if I do this? And if you look at the bottom, we're about $300,000 ahead. We have about $300,000 more dollars in our account if we do the crud versus not doing the crud. In addition to that, we have our $100,000 deduction in year one against our other income, and we have provided about $400,000 to a charity. It didn't cost you anything. In fact, you made money on that transaction. You're a good guy to the charity, and this demonstrates why I said at the very beginning, you don't have to be terribly or maybe really at all charitably inclined in order to make this strategy make sense for you. So the crud benefit summary, again, we received the charitable deduction. We didn't pay any tax to diversify the assets. We didn't pay any tax on the incremental growth. We lowered our effective capital gains by about 10%. We have almost 1.5 in just net payments that we've received out of the trust, and we provided $400,000 to a charity that we didn't pay for. Really, in a way, the federal government subsidized that gift. Charitable lead trusts. Think about these as sort of the opposite in terms of the flow of the money compared to the charitable remainder trust. There are two different kinds of charitable lead trusts. A charitable lead unit trust, where you receive a variable amount every year, or a charitable lead annuity trust, where the charity over the life of the trust will receive a fixed annuity payment. That amount of money that the charity will receive, and I'll show an example of how that money flow works in a moment, has to beat the 75/20 rate, a rate established by the IRS, which is now at 2.2%, a historic low. So if the income in the trust, if the trust can do better than 2.2%, we are keeping that growth for our family, and we're paying out 2.2% a year to charity. If the trust is doing 5%, we're keeping about 3% growth that the trust is not being taxed on. That's going to continue to compound tax-free, and it's eventually going to go to our family. So the tax benefits really for doing this, using this strategy, there's no tax on the gifted portion of the stock. So if we put $1 million into the trust and sell it, there's no tax on that $1 million. You get the same income tax charitable deduction in the year of the transfer, And the big win here, if we know that we're going to set aside these proceeds for our family, we've reduced the gift tax or estate tax on that by discounting the valuation of the gift for those purposes by about 80%. I'll show specifically how that works. So here you see, we say 20 years at the top, but it's actually modeled over a 10-year term. Over that 10-year term, the charity receives $50,000 every year. You see the growth, projected growth at 5% beats that every single year. The remainder going to your family is 1.276, about 1.3. That is going to be valued for the purposes of establishing the effect on your estate tax and your gift tax at about $255,000. So you get the charitable deduction year one. You have a nominal impact really compared to the value that you're transitioning on your lifetime and estate tax exemptions, and really the only thing that you gave up is access to this money over that period of time. So the only real question is, do you need these proceeds if it's part or all of the sale proceeds now, or do you intend to leave them to your family? And if you intend to leave them to your family, this is a great way to do that very tax efficiently while providing for a charity. And again, you can see that doesn't cost you anything. In fact, you net more on your balance sheet after structuring the transaction this way. The CLAT summary: no taxes on the amount contributed, charitable deduction against the amount that is contributed to the trust. You give a percentage of the growth to charity that is really subsidized by the IRS, and you leave the principal and net growth to your family while either eliminating or at least minimizing the estate or gift taxes on that amount. These are relatively complex strategies, so Nate or I would be happy to discuss these with any of you in light of your specific situation. So that concludes this part of the presentation, and we'll turn it back to Andrew for any Q&A.
Great. Thank you very much, Brett and Nate, for that insightful presentation. We do have a few questions that have come in. We'll begin with the following. These techniques are interesting. At what level or sale amount does it make sense to implement them?
Well, in terms of the CRUT or the CLAT, we'll model them out, and it really depends upon your other income that you have. But in each one of these situations, we'll put together a financial model that will show you the no CRUT versus CRUT balance sheet item, and you can make the decision for yourself about whether or not it makes sense. But any sale with highly appreciated low basis assets, whether it's $500,000, whether it's $1 million, whether it's $5 million, we can show a pretty significant tax benefit.
I would say for the intentionally defective grantor trust, the tax-free sale to your children, the low end would be around a $500,000 sale up to infinity. And then for the business management trusts, as long as you care enough about your business, that would make sense to secure the management in the event that you are unable to act.
Great. Next question we have, if I do a CRUT or a CLAT, how far in advance of the sale should I create them?
Good question. This is really a question for the CPA. Perfect scenario, we start planning and structuring these transactions pre-LOI.
Letter of intent.
Letter of intent. Nate and I have both been involved in transactions that have worked out well, where we get involved or we're called and brought in to put together a strategy like this post letter of intent, even post purchase agreement. So long as there are contingencies in the purchase agreement that could theoretically stop the transaction from going forward, then we're early enough. But as is the case in most of these planning strategies, the earlier we're involved, really, the more we can do.
Excellent. Another question. I'm interested in the defective trusts Nate described. Does the IRS challenge these transactions?
The sale to the intentionally defective grantor trust catches the service's attention because you're separating your control and ownership of the your ownership of the business and receiving money back tax-free. So I would suggest, Stephen, since maybe during the Clinton administration the IRS has taken a look at the sale to the intentionally defective grantor trust, we have, just in response to some scrutiny, tried to put a balance of time between the creation of the trust and the sale of the business and some other techniques. But as a general rule, while these in almost all estate planning techniques have been reviewed, they have not been repealed or modified.
Very good. Well, this has been an excellent presentation. I'm afraid that's all the time we have for today, but if anyone is interested in a copy of the slides or any questions about the webinar, you can reach out to Nate Nelson or Brett Larson here or email Sean@truckwriters.com. Once again, I'd like to thank Truck Writers for hosting this webinar and Nate and Brett for your time, and thank you everyone for attending. This web seminar is now ending.